Welcome to Park City, Utah. I'm out here enjoying the slopes. I'm going to take this opportunity to talk about the business of ski resorts. They are all over the country. Park City is owned by Vail Resorts. It is a publicly traded company. They own and or operate about 37 resorts around the world. So we're going to talk about how they perform and walk through their financial statements for the last year. With that, let's get started. Vail Resorts, they operate about 37 ski resorts all over the country, mostly located in the United States. They have resorts such as Vail, which is the namesake, Park City, Whistler, British Columbia. They have resorts in Europe and in Australia. They also have some real estate operations. However, most of their revenues are derived from their mountain operations, lift tickets, rentals, instruction, and other retail associated with their mountain properties. So Vail Resorts has about a $12 billion market cap. They are owned almost entirely, I think 103% of their float is owned by institutions. That is a very, very heavy institutional ownership. When I looked through the institutions that are holding it, there was nothing overly surprising. A lot of mutual funds, your large mutual funds own it. They don't look particularly heavily held by index funds. However, without drilling too much into the details, my hunch would be they're going to be held by a lot of dividend funds. They pay a very hefty dividend. Last year, their dividend was $5 a share, even though their net income wasn't $5 a share, it was like $2.50. So they paid out a dividend almost twice what their net income was last year. So the company has about $2.2 billion worth of revenue on an annual basis. That has been growing year over year. However, in 2020, with the early shutdown of COVID in the spring, which cut off the end of their ski season, their revenue did decrease in 2020. However, I would expect it to continue and pop back up this year and probably exceed the 2019 revenues. Skiing has continued pretty strong. We should start seeing what COVID's going to do when they release their earnings for would be the first quarter when they release those in March. So there's a little overview of Vail Resorts. Now let's dive into their financial statements and see what we can figure out.
Look at Vail Resorts financial statements. We're going to pull up their Form 10-K. This is the annual filing with the SEC. This includes their financial statements as well as management's discussion and analysis. This is for the year ended July 31st, 2020. That is Vail Resorts year end. Generally, companies do that so that their year end is not dividing their most busy time of year. So we're going to spend most of our time looking over their financial statements, but I did want to highlight a little bit on the management's discussion and analysis. So Vail Resorts makes most of their revenue from owning and operating ski resorts. So as we mentioned, they have 37 resorts. Most of them are located within North America. If we start looking at their revenues, so Vail makes most of its revenue from its resort operations. A couple of things I did want to highlight. So Vail makes approximately 51% of its total lift revenues from the sale of season and epic passes. That's a huge benefit to a company like Vail, where a bad snow season would drastically reduce the amount of revenue that they would otherwise get. A couple of things to keep in mind. Vail Resorts has seen revenue increases in every year except 2020, and that was because of the COVID shutdown. A lot of that revenue growth has been through acquisitions. For instance, in 2019, they acquired Peak Resorts, and it added 17 regional ski areas across the U.S. If we look at the lodging segment, this is the second largest revenue stream for Vail following its mountain operations. Most of their lodging are associated with managed or owned hotels at the base of the mountains that they operate and own. So that equates to about 6,000 owned and managed hotel rooms and condominium units. That's a pretty big number. However, from a revenue standpoint, it's actually much smaller than I would have expected coming in. Before actually diving into their financial statements, I expected their lodging and their real estate operations to be closer to 50% of revenue. It is substantially smaller than that. So From one standpoint, I almost view that as a missed opportunity for Vail because they control the attraction that's bringing people in. It seems like they would also want to take advantage of a lot of that revenue associated with lodging. Taking a quick look at the report of the independent public accounting firm, which was PricewaterhouseCoopers or PwC. There were no internal control issues identified for the current year, so it maintains effective internal controls, and there were no material misstatements identified in the financial statements, which is good because they can't file their reports if they are. So we'll skip the basis of opinion. Did want to highlight some of the critical audit matters. So critical audit matters are areas where the public accounting firm had to spend substantial amount of time or effort to evaluate the appropriateness of the financial statements. The first thing identified is contingent consideration. This is contingent consideration associated with the purchase of Park City Resorts. Depending on the performance of Park City, Vail Resorts will have to pay some form of contingent consideration, i.e. the purchase price was not fully determined at the time of acquisition. There was some piece that was based on the projected or was based on future performance of Park City. This liability in the current year is $17.8 million. Now, that's going to have been impacted largely by COVID, which required them to shut down their resorts early last year. That liability actually decreased from last year and was able to be taken to income. Another critical audit area was the valuation of Peak Resorts that was acquired in fiscal year 2020. In conjunction with an acquisition, all of the assets, tangible and intangible, have to be valued by the acquirer. That is an incredibly subjective assessment, especially for a ski resort where a lot of their assets are going to be intangibles, say company name or reputation, as well as lease commitments if they're using national land. Those are the only two things listed by the auditor as critical audit matters. That does reflect my reading of the financial statements as well. There's just not a lot of interesting, exciting stuff going on at Vail Resorts. It's pretty cut and dried. So let's start walking through their financial statements. We're going to start with their balance sheet because that's what they start with. Companies can start with a balance sheet or income statement. It doesn't matter. You can even start with a cash flow statement if you want. Some things here, they have plenty of cash. That's a good thing. They have mostly property, plant, and equipment. That's what I would expect. And they have total assets of 5.2. That's $1 billion because everything is in thousands already. So a lot of these assets are intangibles. So if you look through their intangible assets, which is essentially all of this stuff, those intangible assets total approximately $2.2 billion of their $5.2 billion of total assets. That is a huge chunk associated with intangible assets. And that is because of the acquisitions that they have done over time. Those acquisitions add to intangible assets, particularly goodwill, which is $1.7 billion. And as you can see, it did go up from 2009. That is the goodwill associated with the purchase of Peak Resorts. So total assets of $5.2 billion. If we look at liabilities and stockholders' equity, we have stockholders' equity of $1.5 billion and liabilities of 3.7. The company is incredibly heavily leveraged to the point of debt to equity is 2.8 that I calculated here. That's a pretty high proportion debt to equity. Now, what's even more concerning if we were to look back up here and noting that $2.2 billion are intangible assets. So what's a little bit concerning is that, remember, we have $2.2 billion worth of intangible assets. That's a little bit concerning, especially given the number of acquisitions. So the question there becomes, how well is Vail Resorts managing that debt load to tangible assets? The concern is going to be if those intangible assets are not able to generate sufficient revenue, you're going to run into problems covering your interest payments. We will see that when we look at their cash flow statement and their income statement. So within their balance sheet, there's nothing unusual here. We have current liabilities, which is mostly $500 million of accounts payable and accrued liabilities. They have long-term debt. Now, a lot of this long-term debt has been refinanced or re-upped or converted because of their acquisitions. They're largely funding their acquisitions through the issuance of debt, and that's shown here when you look at their long-term debt. Their equity is pretty much standard fair. There's nothing odd here. Even accumulated other comprehensive income is actually pretty small, and that's going to be reflective of very few financial instruments and very few international operations. If we move on to start looking at their income statement, as I mentioned before, their total revenues of roughly $2 billion, 1.5 of that is their mountain and lodging services and other, and 913 million of that is lift revenue. Their lodging is only $380 million for resort revenue of just shy of the total. Then they have a little bit of real estate stuff. If we move into expenses, the expenses largely line up with the different areas, so they were able to maintain decent gross margins on all of their main operations, which is good news. Now, the thing with last year, as we will see, general administrative expenses largely did not change from 2019 to 2018, despite a substantial decrease in revenue associated with the shutting down from COVID. Given the COVID shutdown, it's actually surprising that they did as well as they did. Their revenue only decreased by about 300 million from 2019 to 2020. Again, that is probably because a lot of it is fixed with the sale of the Epic Pass at the beginning of the season. 51%, remember, is associated with the sale of passes. Moving down to break out some of their expenses, they have pretty high depreciation, which is what we would expect given the nature of their business being very capital intensive. They do have some asset impairments right here. That was actually a write-down associated with some transportation business that took a big hit during COVID, and they don't expect to be able to recover some of that purchase price. At the end of the day, we have income from operations of $223 million. This is about half of what it was the previous year at $467 million. Not too bad given the COVID shutdown. They kind of got lucky it happened at the end of March and not say the middle of January, but some people get lucky, some people don't. Vail Resorts got lucky. Income from operations being roughly half of what it was in the previous year. Interest expense actually went up. Again, that was because they purchased Peak Resorts and funded it largely with debt. So their interest expense did go up. That took a big hit out of their bottom line, where net income and income attributable to Vail Resorts is roughly a third of what it was in the previous year. And we see that in our earnings per share. If we just take a basic net income earnings per share, we're at about a third of what it was in 2019. Now, despite income of $2.45, the company still paid out dividends of $5.28. They maintained, to some extent, their dividend. They did not drop it down to their net income or below their net income. That is going to be a good thing for some large subset of their investor base. And as you remember what I noted, over 100% of their float is held by institutions. And a lot of that is going to be driven by their dividend rate. So they don't want to upset those institutions that are holding their equity. So they're going to try to maintain that dividend rate if at all possible. And in this case, they had the cash to do it, so they were able to do it. If we take a quick look at comprehensive income, as we saw on the equity statement, comprehensive income is relatively light, and that is primarily because there's not a lot of foreign operations in the company, so our adjustments for foreign currency are not that substantial. And they have very few, especially historically, very few hedging and other financial instruments. They added some this year to the tune of $22 million to give them comprehensive income for the period of $73 million. If we move on to their statement of stockholders' equity, there's again not a lot of activity. There's nothing crazy or fun going on. They issued a couple of shares this year that added about $20 million. That was primarily associated with stock grants to employees or options. Moving on to cash flows. Now, this is going to be critical to see how they performed in 2020 when COVID hit. They actually did pretty well and were able to still generate almost $400 million of cash from operations in the period, which is good. And that's what enabled them to continue to pay their dividend. They were still cash flow positive. Now, that is a little bit more than half of what their cash flow from operations were in the previous period. If you look down, depreciation and amortization is one of the single largest adjustments. If we take a look at accounts receivable went down, which provided them a lot more cash provided by operating activities. However, that was partially offset by a decrease in accounts payable. Well, you decrease accounts payable by paying it off, which decreases your cash. You decrease accounts receivable by collecting it, which increases your cash. Also wanted to highlight this deferred revenue, which cost them about $100 million of cash provided by operating activities. So deferred revenue is a liability to the company that decreased mostly because of a decrease in prepayments because of COVID. I would expect that to reverse next year. The remainder of the cash flow statement, as we would expect cash flow from investing activities, they purchased additional businesses. That's cash outflows. When we move on to cash flow provided by financing activities, they did a lot of moving around of their debt, whether it was taking something that was a floating rate that they used to purchase something and then converting it into a fixed. A lot of these items end up netting out such that they end up with an increase in cash flow from financing activities of $375 billion. And that was largely the financing of the acquisition of Peak Resorts in 2020.
And that's going to wrap up our review of the financial statements. Hopefully you enjoyed this little discussion as we walk through the business of ski resorts, particularly Vail Resorts. If you did, make sure you hit subscribe to not miss on future content from Accounting Outside. Have a great day and God bless.